and welcome everybody. Thanks for being here on well, morning here in the US, afternoon wherever you guys are. If you're in Europe, we thought about hosting this session because you know, we wanted to share our experience with Richard and Joel about the program that we just wrapped up in July, and you know, just educate anyone who, you know, is remotely interested in the space and is considering, you know, joining this journey like we did, you know, recently. The way that I'm thinking about the format of this is obviously we're gonna have like brief introductions of the three of us, and then we can kick it off to, you know, some questions. I'll maybe break the ice with some like general questions about, you know, the, you know, angel investing in general and our first experience with tech, and then maybe you guys can jump in with any type of questions that that you have. So you know, me briefly gave a little brief presentation about myself, but I'm you know, I'm a marketing executive for you know, the biggest book publisher called Penguin Random House. I've been doing everything in my career, from investment banking to consulting. I even co-founded a startup during my MBA days, and recently I've been working in corporate on the marketing side recently, but also in innovation space with working with startups, running internal accelerators. And I've been thinking regarding angel investing, I've been thinking about doing this for a while, and you know, got into the space through this TransAtlantic program that I don't know if Ott is here today. I don't think he's joined, but he's a business school friend of mine, classmate, who basically brought me in, and I liked it so much that, you know, I'm repeating, as Ashley said, the new cohort in September as a lead investor. In terms of investment, I've only invested in one company so far, which is like, you know, the one that won the program that we just wrapped up. But I'm on a journey to, you know, like build a portfolio, which is one of the core tenets of being an angel, you know, because people sometimes wrongly think that a few bets are gonna do the job, but instead, like, you know, really few succeed. And so that is one of the things that maybe we'll cover today. But without spending too much time on myself, I'll kick it off to Richard, maybe to introduce himself, and then Joel is the third one.
Sure, thanks, Matteo. Richard Evensen. I've background 20 plus years as an analyst consultant, working largely in the tech industry, financial services, healthcare, other industries as well, mainly on everything from business strategy to customer insights and intelligence to competitive intelligence, really just kind of drilling into companies and figuring out what works and how to optimize that for largely, you know, Fortune 500 companies. Leverage that to get into working with startups, which I have been doing for the last 3-4 years. Loved it. Really enjoy working with startups as an advisor and mentor, which then led me into the whole angel investing part of things. I was part of the first TransAtlantic Angel Conference, which we'll get into more, but fantastic learning and definitely a great experience there with these good folks. And so then I've started to get involved more on the investor side of things, moving from, you know, the kind of mentor advisor standpoint with startups. Right, Joel, over to you.
Yeah, thanks, Richard. So, well, as Richard, I was part of the first TransAtlantic Angel Conference, and I had previous experience with other types of investments, like real estate and stock. And I discovered this way of investing as an angel quite recently, and found that this environment was very favorable to actually starting. I really enjoyed it. Besides that, my background is not in investment. I'm actually, my day job is in a product in tech companies, and that's my day job. And, you know, I guess we'll get to know each other more through the questions later. So I leave it to that.
Thanks to both for your introduction. I thought that maybe to kick off this session, it would be interesting to know from both of you, and then I'll be like a little bit of a moderator, but also a speaker here. But I'll start with you guys. I think it was going to be interesting if you could talk about like your journey, where you are in your journey, where you started, where you are now, where you're planning to go. What is your motivation to be in this space? What excites you? And maybe if you got to that point, because I haven't yet, what is your investment thesis? A lot of, like in the space, we talk about investment thesis, what you look at in companies. I think that could be helpful and interesting for the audience to know, how you're thinking about this journey.
You're going to be polite now, Joel. Okay, I got it.
I saw you were muted first, so I just
that was the problem. Okay, I was just getting ready. So, whoa, all right. That's a loaded question. So I think first and foremost, this is not a destination, it's a journey. And, what I find with every startup I engage with every day, with the more I learn, the more kind of my vision, my goals, even, kind of the investment thesis, as you mentioned, kind of get adjusted. So I came at this from a different angle than some folks. My background, I guess, is I've been an advisor. I've tried to have my own businesses. I had a couple of businesses that did not work out. I did those kind of solo. This last venture I did with a couple others, and now, that has done quite well, 500 people, 30 million plus companies. So again, startup success, which taught me a lot there. Going in then to advise startups, leveraging a lot of the things that I learned from advising big companies and figuring out how to adjust that down to companies that had no money, and really trying to develop best practices. So I came in from that angle. And I would say in terms of being an investor, I'm still an advisor first, investor second. I love advising and working with startups, and investors often will have that role. So where you invest, you want to make sure that the startup you invest in succeeds. And so you leverage your knowledge, your network, whatever you can to help them along the way. So it's not like when you invest in a stock where the money goes in or maybe it comes out. This is much more of a long-term, marriage. It's a commitment, and like a marriage, it's not something that you just say, hey, I'll throw money at it and everything works out. No, you have to put some skin in the game. You have to, be present. You have to help. You have to guide. I mean, it's an emotional journey as well, much more than, I've invested in real estate and quite good at that. And that has its ups and downs. But, when you're in there, for the long run with these startups, and it's just everything's going on, it's pretty intense. I would say TAC was fantastic as a program, because over this 3 months, my kind of expectations radically changed. My understanding of the whole process changed, my understanding of startups and what to look at. I was at the beginning attracted by the shiny object. And by the end, that criteria radically changed. And so, I have a rough investment thesis, but again, it's changing. A lot of it is, business basics. I learned, business basics are huge for me. If a company is not able to reasonably generate revenue, they don't have a solid business plan, they don't have a solid monetization plan, they're just attracting users or members or whatever we want to call them, but they haven't figured out how to make money yet. That's a tough one for me as an investor. It's getting money in, is at least the initial product market fit. And so I realized, I went in saying, no, I want to invest in companies that are making a difference and really doing something radical to improve the world. And I still do. But if they don't have the ability to survive on their own, that goes against all the things I've learned about business over 30 years. And I realized for me, I can't go against that. It just, that's hardwired into me. And so every startup I work with, I make sure that they are able to generate their own revenue, their own profit. You know, they're not just trying to do good. You know, hopefully that's a core part of what they're doing, but they're solid businesses as well. So that's kind of a core piece of my investment thesis. There's a lot of other elements as well around, you know, the team and the individuals on the team and their capabilities, and do they have the bases covered? Are they open, you know, to guidance? Again, I'm more of a mentor advisor, so I enjoy engaging that way. Can they pivot? You know, every startup really needs to pivot once, twice to have a chance, you know. So these are a lot of the things I kind of look for in anything I might invest with. So long answer to a short question. Joel, your turn.
Thank you. So with the 2 minutes I left, sorry. You asked about my journey, Matteo. So from my point of view, the angel investment is only part of my journey. Okay, have been always interested in building my investment portfolio. And don't get me wrong, I didn't inherit millions, and I'm working only on that. I'm just a regular person who prioritized saving all his life from income and has a good portfolio, and I want to diversify it. And the reason to diversify it is actually personal and not financial. It's simply because I enjoy it. I enjoy investing, enjoy being active in investment. And I've been doing real estate in my local geo, and I've been doing investments in stock, and I've learned about it, and stock indexes and markets and securities. I even tried a small crypto bet. Not that it succeeded that much, but tried it. And when exposed to the option of becoming an angel investor without having to invest large sums per startup, then it became a possible vehicle for me to continue with this journey. And for me, it's not just creating a portfolio for us. It's a portfolio for my future, okay? But it's also being active in understanding the assets, in planning the strategy, and executing this. And that's why I actually like real estate more than buying indexes online, because when you buy index or stocks, you're not really involved. It's just pressing a button, you took a decision. So I saw the angel side more similar to investing in real estate from my point of view, because you're involved. You are doing a due diligence, you're checking, and you're investing in one thing that it's not actually replicable. And as I said before, TAC became for me like a gateway to this world, and I pretty much enjoyed it a lot. And one of the things was the thesis, and you asked about that, Matteo. So I'm still working on my thesis, even though we finished our investment in TAC 1. Yeah, because at the beginning of TAC 1, I thought I knew. I came in, I'm pretty sure I know what type of companies I want to invest. And then every time we sat on voting, I'm not sure if everyone here in this forum knows the structure, but there was a lot of voting through TAC to reduce the number of startups that we continue in each session. And through each voting, I learned more about my own preference, okay? So I know I want some decent chances at a good return. It doesn't have to be a safe bet, but these are my personal preferences. It has to have a good possible upside. And if it has some impact, be it social or local impact, or whatever, something that feels me like it's doing something positive, then it will have a plus. But this is the thing, these are the things that I learned through TAC. I didn't came in to TAC knowing this. And I learned it, and I learned it more from what other people or my other colleagues investing shared and asked than from my own point of view. Because every time somebody said, hey, this is important to me, then I said, it is to me as well. Or the opposite, right? And I came in saying, yeah, you know, it has to have a unicorn side. And then all the companies I actually voted for, when you review what I voted for, I didn't vote for the ones that seemed like the next SaaS unicorn. I vote for others. And I asked myself, why did I vote for this? So I think my journey is just beginning, even if we look at the angel part only. I hope this answers the question.
No, totally. I appreciate a lot your answers, and I don't mean to be redundant or repetitive, but I just want to echo what both of you said. Like, if I had to give an answer to my own question, is it's a full journey. Obviously, it almost never ends. I personally just started, but the point is that I didn't know where to start, and like, where do I get the deal flow? Where do I look at companies? How do I even learn? And it felt like this program, and we'll get there maybe in a few minutes, is the perfect way to start, because it's a learning from everyone else. But coming to the to the reason why I personally am doing this. Obviously, there's a financial reason. Like, who doesn't want to have good results for its own investments? It's a diversification, to your point, Joel. I mean, the theory says that out of your portfolio, roughly 10% could be invested in alternative assets. And while I'm also invested in crypto, that is not like doing particularly well these days. It feels like this specific asset class is a lot, to your point, you're more involved. You're more active in understanding the assets. You almost have an impact on your investment, depending on like how involved you are. And then the other reason for me has been, I think networking and interacting and cooperating with startups allows you to stay on top of new trends or new technologies. And like it's always very stimulating, even outside of your job, especially if you have a full-time job. Like, I feel a lot of people do angel investing on the side, the gig, but I think the transfer of skills and knowledge is very helpful, and it keeps your brain going. And then very briefly, to wrap it up, I'm also working on my investment thesis. What you said, Joel, is like very true. Like you maybe start from a point of view, as I said, who doesn't want to invest in a unicorn, but then you start seeing other aspects, and you learn from the other people. I myself like to believe that I'd like to invest in companies that have a positive impact on society, whether it's like the planet, human lives, well-being. But then at the same time, you want to maybe invest in companies that are scalable. So there's more technology there rather than like individual products. So that's something you also look at. You bring in your own maybe expertise. I've been working in the creative and entertainment business for a while now. So maybe that's where I could, in the creator economy space, maybe that's where I can bring more value into or opinion. You look at things like traction. Companies already have some sort of revenue or clients or what they call the product market fit if it's already there. And another thing that really resonated with me, I don't know if it came up in our sessions or I read it somewhere. Think about painkillers versus vitamins. Are these companies already solving a problem, like killing the pain, or it's just like improving what is already there, which doesn't necessarily mean that it's wrong, but maybe it's less needed. There's less of a need. So to your point, Richard, there's like many things at play, but what is really interesting is that when you do that in a group setting like we did, you start looking at things that you maybe have not considered before. So yeah, basically echoing in another different light everything that you've said. Moving on to the next thing, I thought, to your point, Joel, maybe it would be helpful to kind of like provide a brief description of the program for everyone's benefit. It's it's a 3-month program, roughly 12 weeks, where you participate together with between 20 and 30 investors. I believe we were like 25. And then you are provided with an initial list of companies, of startups that you look at, who come in. They give a 1-minute pitch initially. You also are able to look at their investors deck and information on Gust, which is a platform for startups. And then you start looking at those companies. You start kind of like figuring out the ones that you like and you don't. And then together with the other investors, it's kind of a democratic process. You start like voting for the ones that you like the most. So you start narrowing down the list of companies that you will eventually focus on, with the goal of getting to a winner at the end of the program. But before you get there, you get to, like, we call them quarterfinalists, and then semi-finalists, and then you spend the last month of the program doing the due diligence on the finalists. So in our case, there were 5, so you divide in subgroups of people, and then you start really digging into and like pulling the curtain up and understanding what those companies are about. You start looking at their financials, their go-to-market strategy. You set up calls, or multiple calls with the founding team. So you connect at the end of the day with the founders, and you understand the culture, their vision and everything. I think that is probably the most important and interesting part of the process. And then, as I said, the goal is to get to the final demo day to vote for the winner, that the rest of the you together with the rest of the investors end up investing in. So I don't know if I missed anything important, you guys, that you want to kind of like add to this brief description of the program.
No, I think it covers it.
Yeah, you did a great job, actually.
So maybe if there are any initial questions, we can open it up to the floor. Otherwise, I do have a follow-up on the program, but I wanna make sure that everybody has the opportunity to ask whatever they want to ask about angel investing in general, about the program specifically. I guess we're here for this.
Let's give it a minute. So if you have a question, put it in the chat or unmute yourself and feel free to share.
Yes, here. Connect. Hello, my name is Luis. I am a startup founder. I have a question about raising funds, in a pre-seed or seed or bridge investments. Actually, we just built our financial plan, and it showed us that we will need some investments, bridge investment for the Q1 of 2023. But we won't have like any revenue for that time. We will have users and we will have the technology built, but not revenue. What are the metrics that you will need for that specific period? When a startup came around and you see that they have users, but they have the technology, but they don't have the revenue, specific for a SaaS company. And what are the milestones that you will ask me or any other startup in general in order to raise, for example, 300K for that specific period of the development of the startup?
Do either one of you guys want to jump in first, or Joel?
Richard, I think you're the best for this.
No, I don't
know. Really?
I'm the most forward, perhaps, but Luis, good question. And I work with a lot of startups, so this is a common thing. How do we best position to investors, because we realize we need a certain amount of money. My general advice is, when you start your business, start your outreach to investors, start building out these relationships, ask for advice. There's a bit of an old expression: if you ask for money, you'll get advice. If you ask for advice, you get money. And so if you're building out these relationships, often they will kind of tell you that, hey, you should be looking at money. They'll give you some soft signals that they're interested in investing and what they're looking for. So usually that's the best bet, is to try to do that. And that can be 6 to 9 months to actually, make those connections and build those out. If you're kind of starting off cold and going to investors, it depends on the individual investors, and you'll hear different answers from us. Some investors really want to see you at a certain stage. They won't even talk to you unless you're Series A or seed. Others, obviously we're kind of pre-seed and earlier. The criteria is a little different, but even here, sometimes they'll say, no, we need to see traction. We need to see actual revenue and clients. So I would separate out, if you're not going to have those kind of key metrics, you need to figure out the investors that are willing to invest at the level of metrics that you are able to provide. And some, basically will invest more when it's early stage idea, that you have an MVP, you have a few proof points around that. Maybe you have a very interesting technology that could be a game changer. It's basically, it's a radical approach to a very large market. Some of these things here where the potential, usually early stage folks that don't need any traction, often those are the ones that want to invest in something that has the potential to be that unicorn. So you have to show typically very large market potential and how you would secure that. What is your monetization plan? What's your business plan? The thought process needs to be very detailed and make sense, such that somebody could go, yeah, I could see this happening. And then you need to have the team underneath that can actually deliver that. So you go, okay, they've got a great idea, they've got a solid team, this offering makes sense. Okay, let's have a conversation. And then honestly, it's a lot of your personal charisma and being able to develop that rapport and convince folks. But that would be my view. Matteo, Joel, it might actually be good for you to tone in as well, because again, we have very different approaches and investment theses on this.
Thank you very much, Richard.
Yeah, I think that was a great answer, and just to add a little bit to that, I mean, you're absolutely right in saying that, especially investing in a group context, you might have different views. So I think I myself, I think I mentioned it earlier, developed it as part of my investment thesis that I like to see some traction, some numbers, but that is not. That is not necessarily a must. I think we had, can't remember how many, but I clearly remember one company, Inward, from Ying. She already had a product, kind of like it was developed with a no-code thing, but she didn't have any revenue. However, she did have a few customers. So I think to that extent, if you're able to show that there is kind of like a product market fit, or you can prove that there is some sort of like interest, a customer base, someone who showed like basically validated your idea, you're on the right path to generate revenue. And it's funny, I think I heard it recently, I can't remember this analogy. The company is the cart, but the customer is the horse. So you can have the best cart in the world, but you won't go anywhere without a horse, right? And so as long as you're able to prove that there's a customer base and there's a need in the market, I think the rest hopefully follows. But yeah, I'll leave it to Joel to add whatever he thinks should be added.
So thanks, Matteo. I'll keep it short. In addition to what Richard and Matteo said, I think essentially you will go through different iterations of meeting investors. Even in the same program in tech, you will go through different pitches and iterations. So be honest, learn from the first feedback and correct. That's what I would do.
Thank you very much, guys. Thank you.
Hi, this is Frank Monticelli. Could I first expand on the remarks that Richard made, and then I had a follow-up question, and that is, we have a accelerator incubator down in Houston, and a lot of our companies are pre-revenue, but that doesn't mean that they're not real companies. They have patents, they have IP, and a lot of the harder problems, particularly in like energy tech, et cetera, are they're sort of binary, right? You build a prototype, and it either works or it doesn't. And if it works, there's a huge, addressable market. If it doesn't work, so it seems like the Silicon Valley approach is sometimes kind of go for the surer thing, which is fine. There's nothing wrong with that. So smaller paybacks, but sort of smaller risk. And I was wondering if you guys had any thoughts on, because some startup enterprises are far riskier, diversification of the investors takes a larger role. So I didn't know if you guys had any opinions on digitization and alternative trading platforms where you could collect capital from a wider audience that is willing to take. These are probably more speculative investments, but you're getting smaller dollars from each investor as opposed to like a traditional, lead investor with like 3 or 4 parties. Does that? You guys have any thoughts on sort of this emerging digitization of economic projects in the private capital space?
So I'll try and answer that. First of all, just to clarify, in TAC number 1, we had 22, I think, investors, and it was not a big sums, depending on, of course, everyone on their pockets, but we were talking about tickets of 5K. So to the question itself, what do we think about these platforms? I think these are great, but it all depends on what you want to do. I didn't find them fit for me because in these platforms, I didn't have the option to be involved in the investments. You just follow some monies, follow some whatever, whichever model they are, you just follow through. You read something and say, yeah, in or out. You cannot be involved. You don't contact the founders. You don't get reports. You don't provide feedback and see if the founders respond to the feedback. This is a crucial part of my thesis and that I discovered through TAC. We were in discussions through the due diligence with the founders, even a bit before. The founders, when we were already on the semifinals and before, we were talking to them, and the way they responded to our feedback made a huge impact on whether we want to continue with them or not. And it's not that they have to agree, but you do look for a founder that is willing to double check himself and accept maybe criticisms or feedback and change course if needed, or has a good reply, of course. And all of those are lost in the crowdfunded options, which it's simply a different vehicle. I don't think they are bad. I think they're actually doing a great thing to open up investment for everyone.
Thank you.
Yeah, otherwise I'll jump in. Frank, you bring up a couple of good points. One, just for us to clarify. So TAC is all about learning how to be an angel investor, and it's a really great program for that. So it's less about putting the money in, and it's more about going through the process and learning everything possible about startups and investing in startups and the criteria. So I think there's a lot that gets lost if you just go for one of the crowdfunding platforms. So you have a lot of options there, and you can do micro investments, and all of these micro investments can actually sum up to be a decent size investment for the startup. But there's a lot more exchange that happens in TAC. The investors learn a lot about the process of investing, about startups, and the startups actually learn a lot about how to optimize not only their pitches and positioning, but even their products. We got down into product development with some of these folks and made some radical changes to what they were doing. So there's more involved with that whole process. I think the other part of your question was, just investing in some of these longer term investments. So, something that, if the technology works, it could be a game changer. But in some cases, and I see this in healthcare especially, but also in the energy sector or otherwise, that, it could be 5 or 10 years of development before they can even know whether they have something there. I think that comes down to maybe an individual investment decision. For me, personally, that I struggle with that. That's a little bit too far. It's too technically complex for me, to be honest. So I don't personally go into that, but I do know some folks that is what they invest in. You know, they're looking at, 10, 15 year radical, change to how we do things, and, multi-billion dollar potential business from this, and secured by patents or otherwise. So I think that's a good question for other folks as well to think about.
Thank you very much. Very helpful.
I feel like I need to add one more thing, not to the specific question, but I've been mentioning several times being involved and doing, and I might have given the wrong impression that you have to be fully involved to do intact. So Richard and I are some of the group that we wanted to be very much involved, and we did more than was necessary for each of us. So it's a spectrum. There are people that are a bit less involved, and there's more involvement. You are involved, you're not completely passive, but just wanted to give a disclaimer there.
I absolutely agree with that, Joel. And in every conversation that I've had with people, who reached out or interested in the program or even my journey, the way I put it is, the more you put in, the more you get out, right? So like everything in life, sometimes you don't have time to attend the sessions. Sometimes you don't have time to spend, to set up meetings with the companies, with the founders. And that's fine, there's no mandatory expectations to do all the job, but at the same time, I think you can gain a lot more value if you are more involved, because you would learn a lot more. And I don't have anything to invest to what you guys said in your answer, so I think that was thorough enough. I just want to address briefly, before we get to I know you have your hands up. There are two questions in the chat.
Everybody. Welcome to the Seattle Angel Meetup Series. We're delighted to have you here.
Is that me? No, okay. There were two comments in the chat. One from Moshen. Hello, everyone. What would happen to the winner after the final step? If I understand your question correctly, Moshen, is like what happens to the winner after you get to the final stage? And the answer is we all as a group end up investing in that company. So we pool all our individual checks together in an investment vehicle called SPV, so a special purpose vehicle, and then you eventually invest in that company. And then what happens after, if that's also part of your question, is the lead investor. The next round is going to be me. In the first cohort was another person who's not here today. Basically, there's a little bit of negotiation with that winner on the terms. I won't get into the details, but there are a few things that you can discuss with the winner about how that investment looks like. And then in the long run, hopefully it's going to be long as a relationship. That lead investor is going to be the intermediary, the conduit between the invested company and the rest of the investors. As you can imagine, you don't want to have 20 plus people throwing questions and then managing the relationship with that winner. So the lead investor is the face of the rest of the investors. So that person, he or she, would get updates, hopefully proactively from the company. He would, if there's any issue or any good news, he or she would bring it back to the investors to say, this is what is going on. And hopefully the rest of the investors have something to contribute, some answers, some connections in their networks to kind of steer the company in the right direction, which is the whole point that we're discussing earlier. It's an active investment if you want it to be active, versus just hoping that investment goes well. Does that answer your question, Moshen?
Well, most likely it did, since we don't hear back.
Okay, and then the other question was from Ian. How do you measure the return on investment of a startup? You guys, does any of you want to take it over?
I can try. So, well, I think it's very individual. It's very easy to to measure ROI on by the book investment, where you know your returns and just to do the equations and you just get the number and say, hey, great, I can compare the present value of different investments. But the thing is that in the startups, you have a lot of uncertainty. So technically, during the due diligence, you do have the startup's projections of sales, revenues, and you have all the risks. And if you did due diligence well, you will have a good picture of the market and how big the startup, how big a chunk of the market the startup is aiming towards, and more or less an idea of what could be a good revenue in 5 or 10 years. But it's a guesstimate, guesstimate. You guess that. And from that, you can calculate. If you trust those numbers, then you calculate with the traditional formulas. That said, I didn't do that for my investments. Okay, I looked only at the potential of the market and the other investment thesis and put on my investment without knowing an ROI, because I didn't feel that it's something that I can get a number that would mean anything. Like I get a 5% or a 10% or 100% or 200%. I don't know. How can I compare that with something that is like real estate, less risky or less volatile, I guess, not risky? What you do aim is to know that you might have, like there is a potential for a multiple return. That's what you're looking for. At least it's my thesis, and I probably will change it in TAC too. So stay tuned.
Do you have anything to add, Richard?
I was wondering if John wanted to tone in. John has been providing some really great links in the comments for folks, just some other sources of information. So that would, yeah. So, John, did you want to mention anything? John is our guru, so everybody knows.
Thanks. You'll have to catch me up. I had to step away for a second.
That's right. Just looking at the ROI of a startup, how do you figure out what the ROI should be? Yeah. So when we look at angel investing as a portfolio, there's a guy named Rob Wiltbank who was at Willamette University that did a bunch of studies about 15,000 angel investments. Overall, angel investments are getting close to a 3x return is the average that you're seeing. And when that gets divided out by the number of years that investment is being done, that ends up being somewhere between 25 and 30% IRR. So you think of it as a 30% or 25% interest rate, but it varies a great deal. And so if we think about the pattern of venture in general, that venture process is utilizing a exponential allocation. So the power curve is essentially the fundamental principle, which is to say that some very few number of the investments perform very, very well, and a lot of them don't perform well at all. And so it's not a normal distribution with the normal bell curve. It's this exponential power curve. And so we look at 1,000 companies. Of the 1,000 companies, 900 do not get evaluated beyond, oh, that was interesting. We look deeply at 100 companies to then pick 10 really good companies to produce a portfolio. And of those 10 companies, 3 go to 0, 3 go to something less than what you put in. So 60% loss of your initial capital at some level. And then 3 go on to give you some modest return, a 1x, 2x kind of returns. And then 1 will give you better than 5 to 10x. And it will make up the whole portfolio and then still give you this 3x over the whole portfolio kind of return. So in order for you to have a 95% confidence that your
good investments that you did good due diligence on, that you were actively involved in, are going to have this outside return, then we articulate that you really need to be in on the order of 20 deals for that to go. And when you're doing pre-seed and seed, it's pretty clear from the evidence that Wilk Bank put together that follow-on money into your investments is not as good of an investment as going broader and investing. So it's better to write more small checks into many more companies than it is for you to save half of your money and double down. So at Series A, that changes. At Series A, we have, you know, all the MBA things that calculate the value of a company start actually working. And before Series A, they don't actually produce meaningful data. And so when you're in seed or pre-seed and the uncertainty is so high, then diversification is the thing that wins. When you are in Series A, Series B, then you can start getting some predictability, and now you can manage that a little bit different, and it'll work differently. And so for the small investor, then, you know, we're writing small checks. The companies generally want $25,000 to $50,000 checks with a small number of people on the capital table, not a lot of little pieces of people that they have to pay attention to. And so the best way to do that is to create an SPV, the special purpose vehicle that they mentioned before, and put people in that, and then have one person responsible for that relationship. And then that $5,000 or even $1,000 investment by the investor can then represent $50,000 to $100,000 investment into the company, depending on how many people you have in the SPV. And that allows you then to be involved in the company. It allows you to get into many small deals, which are diversified, which then as an investor gives you a better chance of having the investment work. And then if you're actually managing a portfolio of 40 companies, it's really hard to pay attention to 40 different companies. So maybe you share that with your friends, and you take two and they take two. And then in that process, you can be deeply involved with a company that you care about, but all of the companies in your portfolio are getting attention. Does that get to where we need to have a conversation more deeply about?
Love it. This is what we loved about TAC 1 as well. And if you do TAC 2, this is, you get access to John's depth and breadth of knowledge, which is just amazing. So thank you, John.
Yeah.
So one other point I saw in the comments. So Frank asked if you had to be an accredited investor, and asked you responded on that. I'm an American, but I live in Europe. And so I'm actually, it's based on your residency. So I would not meet the criteria for being a US accredited investor, but because I am a resident in Europe, I do meet the criteria here. So for those folks who are wondering, thinking, oh yeah, I can't meet that US criteria, you know, I'm a European, whatever, you might want to reach out to Astrid or Matteo or somebody and check what the specifics are for the country you're in, because you might be able to take part, and it's definitely good if you're able to. Matteo, Astrid, do you know the specifics for Spain, or is that something we would need to maybe take offline? Arthur is
sure.
asking.
The quick answer in Europe to be able to be angel investing is 50,000 annual income or 100,000 in net worth, and for the US, that's I believe 200,000 annual income and 1 million in net worth. But just text me, we'll be happy to get back to you. And then I'm feeling bad for Rolf Chair, who has been very long time with the hand up. I can't wait to hear what the question is.
Thank you. No worries. I just have a question because Richard mentioned something about that the product fit is crucial for angel investing, more or less, and especially based on my experience with seed projects, the product market fit is yet to be explored. Sometimes we especially in tech products, that we have engineers delivering. So we pivot and we narrow down the audience on the way, and this usually impact the runway. And if so, that means our product is not yet fit to raise investment, angel investment, but we're in the process of figuring it out, or realizing where is our niche, or where is the product, where the product will fulfill a certain niche need. How we can tackle angel investment from this side, where the product is still yet in a pivotal, it's not yet fit. So do you suggest we wait until the product is fit, but this requires a certain course until we reach there? So would you be able just to clarify?
I'm not sure if that was me or Joel on the product market fit, but it's tricky. That's kind of Pandora's box. So then, usually there's conceptually things fit together. It makes sense that this should work. And then, you look at the degree of testing in market. Have they, do you have some market feedback that indicates that there's some alignment here? Do you have a team that has the smarts to be able to put this together? Do you have folks that are flexible enough to pivot when needed? And then there's this back and forth that happens. So I think this goes to investment thesis and how early on you're comfortable investing, and what are the criteria of your investment. Some folks, honestly, they go, look, until you have traction, actual metrics, no way. So there's a certain level of product market fit for that. Others go, hey, you've got 2 or 3 customers, even beta customers. All right, that's enough. So it varies widely by investor. And even within our group, it was fascinating to see, just how widely that varied and how much we changed even over the course of 3 months from, no, it has to absolutely have traction. And then we're like, yeah, but I think this one has potential. Yeah, let's go forward with this one. So
let me jump in a little bit with a little pedantic response to that, which is to say, if we think about the lean startup methodology, it basically, the foundation of that is customers happen before product. And so when you have people that are coming at, I have this really great product and I've never talked to customers, then the angel investor should be afraid. Just that. Right? So then if we're going to go into the 4 steps of the epiphany, then discovery, validation, creation, scale are the 4 steps. So what is discovery? Customer discovery is customer problem fit. So as a company that you are saying is supposed to pivot, what customer discovery have you done? Have you actually found a subsegment that has a problem that is screaming madly enough that you can find 100 early adopters that will pay you money today to have a Band-Aid put on the problem today, so that you can say, okay, when I get this product that solves this problem real, will you pay me later? That evaluating who is the customer, what's their submarket, who are the early adopters in that, what do they currently do about that? How are the existing alternatives incapable of doing what needs to happen? That's all customer discovery work. Nowhere in there did I say what the solution was. I just said, I have customer problem fit. There are people in the world who have a problem that hurt enough that they will pay money today to solve the problem because none of the existing solutions solve the problem. Most startups, 95, 98% of the companies cannot answer that question. If you come to an investor and you say, I have investment, or I have revenue, then we sort of hand wave away the question of whether there's really customer problem fit, because there's people already paying, therefore they must care about it. But if you don't have that, if you don't have an ongoing gross growth of customer revenue on a regular basis, then what's the evidence that there's customer problem fit? And then after customer problem fit, there's problem solution fit. And after that, there is customer solution fit. All of that happens before scale. And so almost everyone starts with the whole process of trying to figure this out by, I have a great idea. I've got it built. The MVP is built. Now give me some money and I'll market this thing and I will scale. And they skip the first 3 steps. Can't skip the first 3 steps as an angel investor. If you do, then what you get is a 42% failure rate because the company does not have a market. Sorry, being pedantic.
Definitely.
Do we want to move to Chris?
I see Chris's hand.
Sure. Hi. Sorry, I know we are kind of on the time, right? So hopefully some quick answers. First of all, great to meet all of you. I'm looking forward to hopefully meeting a lot of you during the TAC 2 program that I'll be signing up to in oh, we have another hour. Cool. Yeah, that I'll be signing up to in the next few hours, I think. So I have actually a two questions. One is, and perhaps this has been mentioned before, how do you get down to 70 startups, 60, 70, 80 startups that we start evaluating at the start of the process? Because I imagine you have hundreds of potential startups applying for this funding. And my second question would be, we've talked a lot about the benefits, and Matteo's put me in contact with a couple of people who did TAC 1, and that's been extremely beneficial. I'm very excited to join, but what would the kind of first and second, or what top 1 or 2 are the misconceptions or mistakes that first timers in a program like this would make?
Matteo, that's totally on you.
On the mistakes or on the, I mean, I guess I can start.
Well, the first part of the question is kind of what you're doing, so I'll let you.
Yeah, no, exactly. So you're right, Chris, in that, and John chime in at need, because like obviously been doing this a lot longer than I have, but you're right in saying that, you know, we have the moment, actually from a personal experience, the moment you start being out there and posting that, you know, you're an angel investor, you get an inflow of requests from everybody who wants money, right? And so it really depends, you know, like how much, like we tend to be like an open program, at least from an industry perspective. We, you know, like we don't necessarily have a preference of like, you know, the type of solutions. And I think that is also the great part of the program, where you get to learn from many different types of products, services, and again, industries. There is a sign up link that we usually share with those founders or companies that are interested in the program. The moment they have to go through registration, I realize that there's a drop off of people not wanting to register. So even that is the first selection. And I think you, John, mentioned in the past that you've had editions of the program, of the Seattle-based one, that had maybe too many companies to look at. Maybe you were like in the 100, and then it becomes a little bit overwhelming. So I feel like you found the sweet spot of like 60, 70. We had 17 in the first TAC. So I think that's where we got at, right? Am I missing anything?
Well, so the way we get companies is we run workshops like this, and the companies get excited and they sort of come in this way. We do a little bit of social media marketing, but we're not really writing enough checks big enough for all of the people that are chasing money now to come in. So a lot of times they go to what the normal pattern for startups is they go find a venture capitalist that's the big venture capitalist in the area, and they go, oh, give me money. And then they work their way down from that one all the way through all of the angel groups down to us, right? And so there's a whole bunch of not being prepared on the part of the startups. We have currently 37 companies that have applied to the TransAtlantic. We typically, for our process, need to have one company for every investor, and then everything will work. When we start getting more than 2 or 3 companies per investor, then it starts getting just a little bit too hard for us to process mentally for everyone to get through. So we don't really market very hard after we hit the minimum number. And so that's just us going through and managing our marketing process more than anything else. So when we have an active angel investor, so our goal is for Matteo to grow into being a lead investor who is active, building a portfolio out in public so that other people notice. And so we've been working with Matteo for the last several months to find investors, to find companies, and to structure the compliance of our investment. So those are the 3 core things that a lead investor needs to be able to manage. And we've been using Gust as our platform. It's one of many platforms. And they've been helping us do a little bit of the marketing. And so that platform, the act of filling out the questions on that platform ends up being a relatively effective filter of taking people who haven't thought hard enough about their startup and causing them to at least delay a little bit. And so that goes through. We have had 150 investments come through a program in San Diego, and that was just painful. And so, you know, that first 1-minute pitch thing made everybody's heads spin. And so we put extra things in front to try and narrow the thing down. But mostly our goal is to get all of the investors to look at all kinds of companies so that they can get perspective on the different things that are in the market, right? Not every company has thought through their financial model as clearly as all of the other ones. Not every company has talked to their customers and has a content strategy that's effective as compared to the other ones. And so there's some analysis that the investors ought to be doing comparing the different companies to each other. So we need enough diversity in that pool to get perspective, but we don't need such a big pool that we can't actually get around the edges of it.
Okay, great, thanks.
And then to answer your second part of the question, and then I'll be curious to hear from Joel and Richard about it was about the mistakes of newbies, right? Like what to be mindful of.
Misconceptions or mistakes, yeah.
Yeah. There's one thing that really resonated with me, and I found it like fascinating, which I think goes back to what we were saying earlier about learning from other investors. You will notice that during the sessions where we as a group of investors vote for whoever, you know, is we think is worth going to the next stage. So, you know, quarterfinals, semifinals, and then eventually finals. This is what happens. Let's say we start from 70 companies at the beginning. The top 10, 15, we kind of are in agreement with. Like people do find those patterns of like, okay, these could be like really, really good companies to like at least explore further. And then there's kind of a bottom, I don't know, 30, 40. Yeah, I'm talking about like based on 70, but that's in general. You always have a top, a bottom, and then there's a middle where people have different opinions. Some people see potential in those companies, some people don't, and vice versa. So there are these moments where as investors, we're basically, and John encourages that, like trying to make a case. And I'm like, I think this company has potential because I come from that space, I worked there, I connected with the founder, and this is what I see. And someone else jumps in and says, actually, I don't agree, or like, I don't see that because of ABC. So you see a lot of like, kind of like, and then you go to the vote and you see that the votes change. So it's not necessarily like a concern or a mistake, but something to be mindful of. And that I think is going to happen less and less the more experienced you are and the more developed your investment thesis is. Like it's a kind of a double-edged sword. You can learn from other people's perspectives and say, oh, I haven't considered that. That's actually a really good point. Or you could be persuaded on something that you don't have enough experience around. And the more experience you have, the more firm your position is going to be. So that's something that I found really interesting in a group setting, which could be you know an upside or a downside, but definitely something to be mindful of while in the program.
So let me jump in for a little bit about mistakes. one of the things that we see is that we get tech workers that have an exit of some kind. They've worked for a while at a big company and they're leaving, and their friend says, hey, I'm doing this project. Why don't you invest 100,000 in my brand new company because it's really cool? And they do no due diligence and they just invest in their friend. And then the friend does stupid things and kills the company and kills the friendship and kills the investment. And then the person says, gee, I won't invest again because the angel investing is crazy stupid, right? And we want to stop that, right? You should not be angel investing if you're not doing good due diligence, or they're at least having somebody else do good due diligence to make sure there's a foundation to this thing that you're looking at. And so then the next place that people have problems is they think that they're going to invest in a couple of these things, and it's sort of like gambling. You know, I'll pick the best horse and I'll watch a couple of them, and then we'll see how it goes, and then maybe I'll do more after a couple of them succeed. But we know that the ones that fail tend to fail early. So what you get is I write, 5 checks, and then I start getting failure number 1 and I get failure number 2. So you that beginning phase, you're getting all of these infant mortalities coming in, and you get upset about these failures that you had. And so you never complete the portfolio. So you never actually get to the point where you have a good return because you're not taking into account the amount of uncertainty in the startups, right? And then the third thing is that people come in and they're all excited, and they're so excited that they write a check and they write a check and they write a check, and they just write too many checks for how much money they should be investing. So they're not going to get enough diversification over time. And so if I'm a millionaire and I'm going to write $100,000, 10% of my net worth, I'm going to put into investment, and I'm going to put that into 20 investments so that I can make that go. It's $5,000 per investment, and I'm going to make 20 investments. And I write 10 checks the first year, and I haven't really learned a lot about my investing. Those were under-evaluated companies. So I get a much higher failure rate because I didn't pay attention enough. And then by the time I've figured it out, I've spent most of my money, and I'm not in a position to invest in the good ones that I discover. So I recommend going slowly and learning rather than going fast and being excited.
Great, thank you.
Other questions or thoughts that people have? I see Lydia has her hand up.
We have a question also in the chat. So Lydia, you go first.
Well, Matteo, I've got a question for you about the previous program that you participated in. Asker gave me the heads up on this one. So I'd love to know how your experience was as assisting the lead investor, and then what kind of pushed you to take on the leadership role this time?
Good question. So I'll start from the end. The reason why I have decided to kind of like take on this role for the next cohort is in the spirit of adding learnings to the journey. Not that there won't be any other learnings if I did not agree or did not volunteer to be the lead investor, but it feels like this additional piece allows me to learn more. I mean, I guess the whole experience is learning by doing, but again, this is also a learning by doing element. And as John said before, and I think they mentioned, the role of a lead investor is to number one, before the program starts, find investors and companies. So that is kind of a push for myself, like put my name out there, build a reputation and a brand for myself, which I could have done if I wasn't a lead investor. But that's a good enough or a good, I guess a good enough, motivating enough push to do that. Then there's the negotiation of the terms with the winner. So sharpening your negotiation skills. There's this book, and I want to save maybe the very last question for everybody, if John, Richard, and Joel to share their the favorite resources that you guys feel like other people interested should read or listen or watch. But there is this book that I need to start called Venture Deals, which is exactly about, and we just had a session, I think last week with a great host from Gang's brother on the terms that really matter. So when you negotiate that those terms with a startup, you need to keep in mind a few different things that I don't necessarily know or didn't know before joining. And then the last element that pushed me to be the lead investor is because the lead investor is going to be, as I said earlier, the point of contact and the mediator and the point person between the company and the investors. That allows me to also develop those kind of communication skills and figure out how to interact with the founders and the team and the company itself. So these are all additional elements to the general investment angels journey that I thought were particularly useful and interesting if as I want when I keep moving into this space. And then their first question was like, what were the most interesting learnings? Can you repeat the question? Sorry.
Yeah. Yes, please.
I think all of us touched upon it in from different angles or in different ways. But the way I in general I saw the program as very useful to my case is that, as I said, like you're kind of like provided with the deal flow, and so you kind of have a list of companies to start from versus like going out and finding them yourselves. You have this kind of like group learning element where you learn. The way I describe it or I put it to other people is that you basically have the benefit of a syndicate, which is like where you can kind of like put your money maybe on small check sizes, so you don't need to invest as a single person in a company. But in those cases, you delegate your kind of like choice, right? There's someone else doing the due diligence and like kind of like picking the winner for you. Whereas here, you're a lot more involved, right? Like you can basically have all those type of interactions and conversations, not only with investors, but also with the companies. And as I said earlier, it's up to you how you manage that. And just to interrupt, and I'll wrap it up. The most interesting moment for me during this first the biggest learning, I guess, is towards the end. One of the other investors, when we were debating, which company was going to be the winner. Obviously, there's so many elements at stake, like the due diligence and like what you heard from other investors, unless you did the due diligence yourself. And then one investor said, what I encourage you to think about is, if you haven't developed your investment thesis yet, try to think about how this investment fits into that, right? Like when you cast your vote, try to make it consistent as much as possible with what your journey is going to be, and maybe remove yourself from how close you are to the product or the industry, or how much you like the kind of like the founding team. And I thought that was like a really interesting point that he raised that I haven't thought about. And I think it's something that if you're involved in the angel investing space, you should like keep in mind going forward. So that was kind of like the highlight for me. But I hope that answers your question.
Yeah, last little follow-on was, how did you find the time commitment beyond the typical participation in the program?
Sorry, can you clarify? Beyond the typical participation, what does that mean?
Yeah, for taking on the additional kind of assistant leadership role last time, so how many hours extra per week do you think that added to your kind of commitment to the course?
Well, it added a lot of hours before the course started, because as I said, it's about finding investors and companies. So it's been a lot of extra work outside of my full-time employment. A lot of weekends spent doing that. But at the end of the day, I always go back to this: the more you put in, the more you get out. So like, if you're committed to do that, I think you find the motivation and the drive to do that. And then I think throughout the program, there actually won't be any extra necessarily an extra time, because you're basically a peer among other investors. And then when you get to the end of the program, what I learned actually shadowing the first lead investor is when you get to the end and maybe to the finalists, you want to start developing those relationships with those companies, with those founders, so that once you get to the negotiation phase and like, you know, to the managing the relationship, you already have a sense of like how those people are. But up until then, I think you're just a peer in the voting process, in the, you know, evaluation process, and then I guess your involvement starts after the program is over, with the negotiation and the communication with the winner.
So how many hours a week are you spending on this thing on an average basis, right? When you're in the program, doing the regular program, how many hours a week? And then how many hours per week were you spending before the program started, Matteo, as the lead investor, doing the work that while everybody else is sleeping, not actually doing any of the work to get the companies?
So starting from before the program, so these very days before TAC 2 starts, I would say an average of 1 to 2 hours a day extra, which means some days it's gonna be 2, 3, 4 hours, especially when you have a weekend, like you commit like a full day, full day is maybe an exaggeration, but a full half a day to that. And some days you just can't, because you have, you know, other commitments, you still have a full-time job, but you balance it out, right? Like you don't, there's no like right exact amount of time, but that's kind of like the average. And then throughout the program, I would say, you know, beyond the weekly time commitment, that is we usually block out, John, 2 to 3 hours every week for our sessions. Some of them are shorter, some of them like get to the 3 hours. I keep going back to this: the more you put in, the more you get out. Like when you get to that shorter or smaller number of companies, whether it's like you know, quarter finalists, semi-finalists, and then obviously finalists, you're encouraged to, you know, set up time with those companies that you want to kind of like learn more about, and go back to the investor group and say, by the way, guys, I had a conversation or two with these 2 startups, and this is what I found out, A, B, C, D. So it's also like informing the rest of the people of what you found. But that is up to you. You're encouraged to do that. You don't have to. You can set up time with like 5 different companies, just one. It's entirely up to you. And then I think once you get to the due diligence phase, there's also an extra effort to put in. I can personally say that the month of the due diligence was a very busy one for me. I was traveling, I got married, you know, it was a lot going on, and I wish I could spend more time talking to that startup, but I couldn't. And that's fine, you know, like you're still part of a group that is doing the due diligence, that is gonna look at other things on your behalf. But the point is, like, nobody's holding the gun against your head and say, hey, where are you? You didn't show up. Like, what are you doing? It's entirely up to you. But there's definitely like an extra amount of time on top of the regular one that you're encouraged to do if you want to experience this program properly. I'd be curious to hear from like Joel and Richard. What is your view about the time spent on this?
It's such a good question, because initially, you know, I had to ask permission from my wife to have time for this session, because, you know, we have young kids and we split between the house diligence, you know, family duties. And I said, yeah, you know, we have a session every Thursday, and it's in the evening, so we can manage. And, you know, it'll be 1 hour additional hour sometime during the week. And it was more than that. And it was more than that, not only because I really misjudged it, it was because I wanted to do more than that. I wanted to understand more about the startups. I could not do anything beyond the 3 hours of our meeting on Thursday and just choose randomly, but then why am I doing it at all? You know, so it did take more than that. At the beginning, it took a bit more because I was completely new. And I really wanted to read about each of the 60 plus startups. So it took time. Then in the middle section, when we were with less startups, I got a better view, and we weren't close to the due diligence. It was a bit less during the week. And then we go to the due diligence, where it depends on the team that you get, the expertise, what you volunteer to do. You could get a lot of work or less. So you do need to be prepared to have several hours a week of homework if you want to take something out of it, as Matteo said. That's my point of view.
Yeah, I came at it from a different angle. Part of it is I'm more or less semi-retired, so I had time available. So I guess my approach was, I'm paying a certain amount for this program. I'm going to get as much out of this as I can. So I think I beat everybody in terms of the amount of hours I put in and the dollar per hour metric there. But it's, again, everybody has their approach. We saw people that literally just showed up, for not even all, some of the weekly meetings. And they really didn't get as much out. For me, I'm like, wow, this is great. They're giving me these interesting companies on a silver platter. They're giving me all this information about them, so I don't have to drill. I can find out. They're giving me access to them. I can go and set up a meeting and talk to these guys. If I want to invest in them myself, I can. They're giving me guidance on how to do due diligence and come up with this investment thesis thing, which I had never even heard of before. And we're having, interesting debates, during the sessions and offline. So yeah, I put a lot of hours into it, but I saw it, really as kind of a crash course MBA on how to be an investor. And so I feel like I got so much out of this because of the time I put into it. So I guess, my approach was, as Matteo said, you get out what you put into it. If you can carve out the time, there's so much you can get out of this, and access to John and his wisdom. And then there's other investors who I found, provided so much net value to my approach at looking at startups and engaging with them and how to do these things. So I'm still processing, honestly, all the stuff I've learned, and we're a month out or more from when we finished the program. So yeah, again, I was happy to put in the time. I had a blast. My wife was not so happy with me. I have to be upfront. She was not keen on me doing this. She's like, this is going to be demanding, and I know you, and you're going to be full in on this. And yeah, so we had about 3 months where I was not as available as I needed to be, at which point now I'm taking 3 months out, and it's just her. I'm not allowed to invest in any more startups. I'm not allowed to do any more programs. So that's my way of balancing, I guess.
I want to add a note after you, Richard, because what happened here is one of the beautiful things about TAC, in my opinion. Richard and I have different backgrounds, different time availability, different knowledge. We even have different theses in many parts. We might have in common the problem with the time sharing of the wife and the interest in learning, but still we're completely different people. And that's what happened with the other 22 different people. Just being there in the room, even if it's virtual, doesn't matter. Being them with the other people and hearing their point of view was enough to make it worth it for me. So here you go.
Other questions from anyone?
We don't have that many questions in the room. I would really like to understand who do we have here, and why is everyone here, and what are they looking for? So for anyone that hasn't spoken, do you have a question? Would you like to share why you are here and what you're looking for? We will stay here we've scheduled another half an hour still, so all yours. There we go, we have a question.
but since you asked for me, I just came to Barcelona in the past couple of months. I used to live in Dubai for the past 3 years. I was part of a startup, so I was an employee of a startup. I was handling their strategy, and today I moved to Barcelona, and I'm working with a portfolio of startups that I think I mentioned before that are struggling, that exist, and without realizing what's a lean startup methodology, without creating the discovery, without understanding the users. So I'm trying to help these startups, and definitely I'm interested to understand as well how angel investors would participate in these startups and what are the methodology behind angel investing, etc. So this is why I'm here. Pleasure meeting you all.
Sounds good. Thank you. We have a question in the chat. Matteo, would you read it out loud and address that?
Sure. So the question is like, how do you tackle valuation? What is the typical ownership percentage stake for angel investments? I mean, I don't. Since as we were saying earlier, we pull together, you know, each investor's money, which is $5,000 each. Depending on the number of investors, we get to a total amount between, you know, like minimum of 100,000 up to, again, depending on the number of investors, we're like 30 investors, 150,000, and you can do the math. So based on that pool of money, the ownership of the company very much depends on how much they're raising and at what valuation, right? So and this is something, and the valuation is usually set by the company. So they come in and say we're raising X amount of money, for this valuation. And this is something that, for example, I learned by shadowing the lead investor in the previous cohort, is that you don't have so much room for negotiation around. And the reason is because you're not going to be the only group of investors investing in this round. There's other, you know, investors, and so you can like move from that set valuation so much. And I mean, I don't want to get into the details, but there's a whole, you know, like concept that there are the whole concept about pre-money valuation, post-money valuation. So there's no like straight up answer to kind of like the percentage of ownership that you take into the company. And I think is that I don't know if John is the workshop that you posted, but the recording from last week's session with Greg, if I'm not mistaken, who was talking about deal terms. He spent a good chunk of time at the beginning to talk about, you know, valuation and how to think about that, which is very, I think, helpful for me, enlightening. So I encourage, if you haven't posted it yet, maybe we can post it to look at that, because he basically tackled the concept in a very engaging way, and it could be really boring and tedious and tricky. So I think it's a really good thing to look at.
Matteo, is it generally done via safes, or does it depend on the individual company that comes through and is selected?
It is usually safe. So it's a convertible note. No, it's not.
You have to be careful about the difference between a safe and a seal and a convertible note and all of the little details of all of those. But the key point is we have a lot of uncertainty at the beginning in the pre-seed stage about what the valuation of the company really is, because we don't have any of the MBA equations actually functional. And so it's really a relationship between where the investor's at versus where the company's at, which is usually more negotiation than it's available for us to have. And so we just pass off the question of what the valuation is by doing a convertible note. And then let the next round decide on what the valuation is. And so that process then ends up with a random amount of ownership of the company, but we put a cap on it to try to bound it a little bit.
Okay. Cap and a discount, I assume?
A cap and a discount. And the talk that Greg did is a really good one. He covers it pretty well. And so I'd encourage you to look at that. If you can get to a price round with a valuation that everybody agrees to, hallelujah, right? Just do a simple preferred round. Any other questions or thoughts?
So I'm just curious, so the folks here, could you raise your hand if you're looking to be an investor? Because sometimes it helps us understand who's on the investor side and who's on the startup side. So Lydia, Chris, looking to be investors. Are there other potential investors here? Frank? Okay. Kind of figured you, Frank, given the questions. Arthur as well. Thanks.
And from the startup point of view, how many of the folks here are startups that are thinking of taking their first round of funding? Louis? Just Louis? Well, then there's a big gap in the middle between those that are thinking of writing checks and those that are thinking of taking checks. So
I'm kind of in both worlds because I'm also here on behalf of an incubator that's got some companies looking for funding. So I was dually participating to see if any of those might be, good candidates to go through your program.
And so with the early stage companies, it makes sense to spend a little bit of time on the clarity around their customer development and where that is, and try to understand what they mean by traction, or at least help them get to a notion of traction of some kind. I am particularly pedantic about this, in that traction is not only revenue, but it's week over week growth in revenue, and trying to get them to be focused on weekly metrics that drive their business. Almost none of the companies are doing that at a meaningful level. And so then if you have your customer going, right, so the mantra we hear from Techstars is team, market size, market size, traction, and then idea, right? So idea being last, right? We don't really want to talk about what it is unless we know that we have some kind of big market with some kind of engagement with that market in a meaningful way. And you can do engagement with the market without a product.
And one of the things I just wanted to mention that was a big learning from tech, because I started out, I got attracted by the shiny objects. I love the ideas and the markets. I came from that angle. I'm like, no, this is the way to do it. If it's a solid idea and a great market, it's got to work. And literally over the 3 months, I started to watch founders crash and burn. Great ideas, good market sizes, a lot of pieces, but they didn't have the dynamics, they didn't have the team. And so by the end of it, I had actually gone over to the other side where I'm like, no, the people are really, really crucial. You can have a great idea, a large market, but it's basically, it's like trying to get around the world in less than 80 days with no money and all kind of traps along the way. That's a startup's life. And does the person have the ability to kind of get through that? And there's a lot of folks who just didn't. The first sign of issues, they were kind of either giving up, which is horrible if you've invested, and they're like, oh, I'm done. And I've had a few startups go through that. Or they didn't make the best choices and so tripped themselves up. So it's an interesting, again, the 3-month process is fantastic in that you get to watch these startups over a period of time, engage with them. You see certain ones that improve. They prove out their ability to pivot. They prove out their strengths. They hire people. They totally adjust their offerings, their go-to-market strategy, monetization strategy. I mean, all of this is happening in this 3-month period. So it's really a fantastic program. over the 3 months, because if you tried to do it quickly, you would miss out on a lot of this back and forth, a lot of the change, and a lot of these other things that have taught us so much. So bit of a side note, but I just wanted to add that in there as well. Other questions from folks?
Yeah, I have another question regarding the companies that are going to be looking for investment. So, you gave me a good answer as to how they get into the program and how we can end up with kind of 40 to 60, 40 to 70 of them. But do they have any buy-in? Are they putting anything down in advance in order to be part of this program? And two, what does the drop-off look like from their side throughout the process? Because I assume some of them kind of get in a bit too deep, or end up getting funding earlier than by the time we would have finished the program. So what do those two things look like?
Matteo or Joel, do you want to tackle that in terms of what we saw? Because we saw enough of that in the TAC 1 program.
I think for the first part of the question, Matteo should answer on the are the companies buying? So let's start from there.
Yeah, I mean, like they are definitely they're definitely committed. I don't think we found like a situation where they got to a point where they raised enough money, and I don't know if it happened in the past. I'm looking at you, John. They raise enough money and they're like, okay, we're done, bye.
Sometimes we get companies that do that, that are going fast enough that they raise money and they drop out. But usually we try to negotiate, we know how big our check is. If you win, then just save us that amount in your round, and you just don't have to close your round. And in fact, you can close the round for everybody else, but just save that much for us. And usually that works fine. But sometimes, the companies are not cooperative in that concept, and they just, rush off. Usually it's the other way around. However, usually the companies get confused about something, distracted by something, something's not working in their company, and this feels like too much work to answer these crazy questions that we're actually not ready to answer yet. And so they go back and work on their product again, because then asking questions about customers is too confusing.
But I think John, that is also part, like it's a feature of the program. It's almost like an accelerator without necessarily being an accelerator. For the company, yes, it's obviously about the money and the funding, but there's a learning process for them too. So for some of them, it could be overwhelming, as John just said. For some others, it could be very, educating and useful, because you start getting asked some questions that maybe no one asked before, unless you already got like a round of investors. And I think it's challenging for them at times, and that could be a good thing. So what we are looking at is also an evolution, especially for those that get to the end of the program. You see from where they start, especially during the pitch, to where they get if they get to the final. So it might not be only about the money, although obviously it's always about the money, unfortunately. But it's also about the process, not just the destination. And I think the other part was like, and I think you answered it, John, about the application. There's a form to fill out, and then there's an application fee of $100 for them to participate. Which surprisingly for some of them are like, oh, like I want to spend that money to apply. I'm like, all right.
Great, thank you very much.
Yeah, so the typically what happens is the $100 keeps the people trying to fund their book and their bar out of the question. And we typically, we've been working with Gust a little bit to get some metrics on the difference between people constructing their portfolio, their answers, and those that actually apply. And we have twice as many companies build a profile for us than actually apply. So only half of the companies that build a portfolio actually hit the apply button, which means that they get into answering some of the questions and then they can't figure out the answer well enough to feel like they're comfortable to apply. So just the act of building your GUST profile, and then as you move forward, the process of building your data room for the due diligence forces certain questions to be answered that haven't been thought of before when you're focused entirely on your MVP. And that really ends up being very useful for the companies. And it's not unusual for us to have a company come in the Seattle Angel Conference version of this, come in, not get anywhere, come in again, make a little progress, come in again and make a little more progress, and eventually get funded at the end. Because we're changing the investors dramatically each round as we go forward, it's essentially a new group of investors each time. And as a result, the companies are getting stronger and stronger. And then by the time they get to our finals, frequently the finalists get funded, if not by us, then by one of our partner angel groups, finds them interesting enough to fund them within a couple of months after our program. And so that's not unusual for, I have this great idea, but I haven't got any foundations I have a functional business with momentum to take maybe 18 months to 24 months for a company. That has happened more than once.
Okay, great. And talking about GUST, like if someone wants to sign up, when would you start getting access to that, and what would that look like from our side of things? Would there be access to that in advance of the first meetings? Would you be able to, start having a look at the companies in advance, or does it all happen on quite a rigid structure, rigid timescale?
We usually don't give people access until a week before we have the pitches. So like the first meeting for Seattle Angel Conference will be on August 30th. This is different than TAC, which the first meeting will be on September 15th. So we'll add people next week for that meeting for Seattle Angel Conference, and then introduce them to the GUST and show everybody how GUST works. And then they'll have a week to go through before the 1 minute pitches, and then another week to go through after the 1 minute pitches before they have to decide who's in the quarterfinals. So you have a 2-week period there to go through and evaluate it. The hard part is that we get overly enthusiastic people that go in deep and try to do full due diligence for all of the companies, and they hurt themselves when they do that. Yeah, I'm looking at.
Are you looking at me?
Yes, I am. And so, what we're trying to teach people is that there's a certain amount of, sort of looking at the surface and peeling the onion, and then, cutting away a bunch that you don't need to understand the gory details of the company to decide, no, this is not the company for me. You can just filter lightly and then get deeper and deeper over time, and then get down to the ones that are really interesting, that have foundational things in place, and then we can do due diligence.
Gotcha. I think I might be in the same boat as Richard by the sounds of it, though.
It was like Christmas.
Pacing. You have to learn pacing. Yeah.
Thank you.
Yeah, one other value add that, for those startup founders or folks more on the startup side is, by going through this, even if you don't end up being an angel investor yourself, you really start to understand how to pitch for investment and all the different types of investors and how to work with those different types. So I think for me, on the other side of the fence, besides being an angel investor, as being a startup advisor, I learned a lot about how to optimize, your pitch pitches, positioning, and dealing with potential investors, because you're exposed to so many different personality types and you see so much of what works and what doesn't from other startups. So there's a rich learning there for startup founders as well, if you're looking to really kind of optimize how you pitch for investment.
Sorry, Richard. Regarding that part to pitch of investments, to investors, I think that there will be a difference between investors from the US and investors from Europe, doesn't it? Or how you, because differentiation in cultures maybe could be a bit, I don't know, maybe I'm misunderstanding how it works, but could you please explain me a bit if there is a difference or not, and how you would tackle investor from the US and investor from Europe, or maybe an investor from China or Japan, or different cultures? I mean,
what I would say is, because you're in this group with 20, 25 different individuals, and the nice part about TAC is it is multicultural, so people from all over the world. I'm not sure I would say that there were cultural differences as much as just personality differences and how they would approach, looking at a company. What did they look at first? What was important? How did they ask questions? How did they engage? And so what we saw is the startups that took part, had to really adjust to a lot of different personality types, and that's the reality out there. When you go out and you want to get investment, let's say from a bunch of US investors, it's not one size fits all. You cannot pitch each one of these individuals in the same way. They're individual personalities. They have their individual values and criteria and needs and processes and all that. And so by taking part in this, you actually start to understand a lot of those mechanics and how you need to adjust to that as a startup founder pitching, for investment. So I would say it's, it exposes you to far more personality types, in this incubator very much. And I think there's value for, startup founders to come in as investors, to be part of the process. If you're not, ready to go and do everything yourself, just to be part of the process, to connect with other investors, understand how different investors think, answer in your own mind, okay, wow, if I had to pitch to this person, that's a totally different approach. But that person, there was a couple people there that represented, large VC funds. I'm like, wow, yeah, you don't want to discredit those. So you need to understand how to do that. So I think, from my side, that was a bit of a surprise learning that it's, I kind of came into this, oh yeah, no, in the US, you do it this way. If it's in France, you do it this way. And so like, no, it was a lot more nuance. And it came down just to individual personality types and being able to understand, how do you pitch in different ways to different types of people.
Thank you, Richard.
Yeah, thank you. Great question.
Although, just to be clear, we have a bunch of MBA trained folks who are trained at US universities as a bunch of our members for this last round. And so I suspect that dominated some of the tone of the conversation a little bit.
Other questions, folks? I have a few minutes left.
So one of the things that I keep asking people for is their Twitter address. And one of the common responses from Europe is, Twitter's not really a thing here. Like being on Twitter and talking to people is a social thing that everybody should do, and therefore it's a tool. However, a bunch of the people who do early pre-seed investing are very active on Twitter. And so if your goal is to find people who are active on Twitter, who are also, if your goal is to find people who are active early pre-seed investors, you can find them on Twitter, where you can't find them on Facebook, and where you can't find them effectively on LinkedIn. And so if you want to be raising money, or you want to learn about how to spend money in this pre-seed thing, there are people you probably ought to be paying attention to. So Twitter is probably the most effective place to get insights into early pre-seed investing, unless you're going to actually be doing it of any of the social media. And so just because your uncle or aunt isn't using Twitter doesn't mean that you as a pre-seed investor shouldn't be at least watching Elizabeth Yin and her conversations. So let me urge you, if you don't have Twitter, to get one and to watch Elizabeth Yin, if nobody else. And we can probably help you find a dozen other people to follow as well, including Matteo, who might start doing tweets one of these days.
I think John, your list, that was very useful for me. It was a good piece of advice. The list of people, the Seattle Angel Conference account, or the Startup Investor Accelerator, one of them, probably the former, follows, is a good one to check, because then you would find, I mean, it's thousands of people, but it's a good starting point. You can read the description, you can see who's an investor, who's a founder, startup space. So it was very helpful for me to start following those people, those accounts. Maybe I have it handy. Hold on.
I don't know how to do lists on LinkedIn. You know how to do lists of people on LinkedIn? Yeah, on Twitter, there are some angel lists on Twitter. I haven't been following the lists. I've never gotten good at that. I just follow some individuals, but I think the folks that are being followed by Seattle Angel, and we have a handful of Twitter addresses, so those can be useful. So any advice on building our Twitter accounts for non-Twitter active users? Yeah, I think probably the best thing to do is, once you get in, is to go find, like, come to me and go to my Twitter, or go to someone who's doing something useful, and then do a search against them for angel investing or startup or something like that. And then just follow those people who are actively engaged in that process. And so we know, like, Elizabeth Yin is the one that's sort of on my mind a lot lately. But in Seattle, we have Kirby Winfield from Ascend Ventures, who's pretty active, and Leslie from Graham and Walker, who's pretty active. And so there's this collection of a handful of people that are, intersecting with each other in an interesting way. I think it's fair to say that how Seattle thinks about angel investing and how the Bay Area thinks about angel investing are somewhat different. And so I don't pay as much attention to some of the people in the early Bay Area as much as I pay attention to people who are sort of outside of the Bay Area. Elizabeth Yin at Hustle Fund being one of the exceptions. Other thoughts?
Yes, I wanted to say something. So if you have been in this event today and you have enjoyed it greatly, or if it was any helpful to at any level, so I'd really appreciate if you know people that would be startups looking for investment, if you could let them know about the program, if you think they would benefit from this, or if you're an investor or you know other investors that would be benefiting from a learning by doing process like this. I'm sending the links in the chat. If you can just share this with your friends or make a post about us. We are relatively new in Europe, even though the US activities have been more than 15 years. Sharing always helps, and also yeah, if this is useful to you, might be useful to your friends as well. So we appreciate if you can spread the word with us. Thank you. That's all from my side.
Thank you as well. Thank you for this amazing event. Thank you, John, for the mentoring as well.
So we do have, I posted the YouTube channel into the chat a couple of times. If you click on the 3 little dots at the bottom of the chat, you can save the chat. That's a useful way to keep all of the links and be able to go back and get things. There's over 100, I think it's close to 150 videos in the YouTube channel right now. Some of which are world-class workshops on some of the nuances of specific things that I think are worthwhile. Not all of them are world-class, but some of them are spectacular.
Sounds good. Well, I think it's my turn to thank Matteo for bringing this event together. Thank you so much, Matteo, for standing up, sharing your experience, and bringing your learnings to the next stage. And thank you so much for Richard and Joel for coming here and sharing so much of your knowledge and your experience. It was really great. I learned, I didn't know the things you learned, so it was very interesting for me as well to be listening to the things you have been experiencing and what you have been feeling throughout the process. So thank you so much for that. And also thank you for everyone for being here. If you want to engage more, we have about 8 events in the next 2-3 weeks. So we do a lot of events. I encourage you to follow our channels on LinkedIn or on Eventbrite or on Meetup, wherever you find us. And we hope to see you in the next event.
What is the next event?
The next event in Barcelona is tomorrow. It's an open coffee happening on Attico Med. The one after that is also in person, happening on the 25th of August. It's a Thursday. It's devoted to brand storytelling. So if you have a brand, a startup that needs to get the story phrased, we have an expert that will be sharing his expertise. And then we have further events the week after about angel investing, due diligence, what are the trends in investment field, what else do we have? Financial modeling, and then we have an information session. That's it for now. We'll end the event here. So thank you so much for everyone for being here. Goodbye.
Thanks, everyone.
Thank you very much.
Thank you, everyone.
Sure.
Bye-bye.